We turn our focus now to today's economic news. There was a lot of data out this morning related to both the consumer as well as manufacturing. We're going to bring in Michael Gapen. He's the director and senior U.S. economist of Barclays Capital. Michael Gapen, welcome to the show. Great to have you here on Fast Forward. A lot of people talking about a double-dip recession. Morgan Stanley coming out with a report today looking at the global picture, suggesting much slower growth. You're not quite that pessimistic, though.
Well, certainly, I'll just lead with the conclusion. The downside risks have dramatically increased, right? So we think that we will see an acceleration of growth into the third quarter. We're thinking it might be somewhere around 2%. That's built on two factors, a rebound in auto production and gradual recovery in consumer spending. The first part of that we are seeing. If you look at the industrial production report, some of the auto production rebound numbers are in there, so that appears to be happening. The bigger unknown is, will consumers continue to spend at the same rate that they have been? If they do, as energy prices subside, real spending will increase. The open question is, the consumers faced a lot of shocks, including weaker equity markets, fears from Europe, an uncertain political environment in the U.S., and what's the risk that they just throw their hands up and say, I've had enough? And if that's the case, then certainly a recession is not out of the question.
Well, how do you know which way consumer spending is going to go if you're trying to figure this out going forward, which is what we all, of course, are trying to do? Because when I look at consumer confidence, those numbers were very weak. The Michigan number was weak. Where I'm looking at the Bloomberg consumer comfort number, that number was incredibly weak. Yet, on the other hand, we also see that consumer prices are rising, putting more pressure perhaps on households. So what are you looking at specifically? What do you think is going to be the biggest factor as for future spending?
Well, I think it'll be the ongoing move in energy prices. So you could argue that you have a two-tiered consumer, that there's an upper-income consumer that holds a lot of wealth. Shocks to equity prices and wealth certainly affect their behavior. But for the vast majority of households, they don't have overly significant holdings of wealth. What really drives their month-to-month consumer behavior are things like energy prices and gas prices. If you get an ongoing decline in those, then we think strength in consumer consumption will show through. But right now, it's still a big if. We need to see follow through. In terms of what causes the consumer to change their course and retrench significantly, a lot of that is related to uncertainty. So you bring up 2 points, the sentiment indices, equity prices. At some point, consumers say, we've had enough. The future is too uncertain. What I'm not going to do is buy a car. I'm not going to buy an appliance. I'm not going to buy a house. And that's when we get into problems. So we're in that area where confidence is important, and that's a pretty nebulous factor.
Okay, well, in terms of what the consumer is feeling immediately, right, crude prices have dropped quite dramatically since the beginning of the year, so that seems like it would bode well based on your thesis. What else do consumers look at? Are they paying close attention to the stock market volatility at this point? Are they paying close attention to, reports on the unemployment rate? What affects their confidence as it relates to the markets the most?
Well, certainly wealth is a very important contributor to consumption. We just find that it tends to be more of a lagged change in wealth. It's not the stock market yesterday that affects my consumption today, but what's happened over the past several months or quarters. So if you get a decline in equity prices that is sustained, that will eventually lead to weaker consumption. On top of that, you have we just went through 2 very bad political situations, one with the threat of a government shutdown and a second of debt ceiling debate. It makes us less confident in our policymakers. So what's changed and what we saw in the University of Michigan survey was consumer attitude shifted from, I'm just not quite sure if government policies will work, to now consumers saying, I'm not sure government wants to do anything nor has the ability to do anything. That type of confidence shift can be a problem.
Along those lines, the Federal Reserve, do you think that they're likely to start a monetary stimulus program?
Yeah, we're very up on high numbers now for quantitative easing.
I'm losing track.
Given our baseline, we would say no, but obviously downside risks have increased materially. So if the Fed has to mark down its forecast further because the auto rebound isn't as strong or the consumption rebound isn't as strong, they would suggest they have policy options available. So we would say it's conditional on the outcome. Markets are certainly pricing in a much weaker economy going forward, so the Fed is weighing its options.
All right, Michael, we have to leave it there, but do appreciate your insight here on Fast Forward. That was Michael Gapen, senior U.S. economist at Barclays Capital and a Bloomberg Best economic forecaster.